Welcome back to the Explainer, everyone. Today, we're jumping right into the highly anticipated applied module of our ASC 450 training. We're going to take the core contingency rules we mastered in previous lessons, those strict rules around probability and reasonable estimates, and drop them directly into 4 real-world scenarios. We're moving out of the theoretical framework and straight into practical application.
We've got 4 distinct stops on our agenda today: warranty obligations, guarantees and indemnifications, environmental liabilities, and finally, sales and marketing incentives. Let's get right to it.
Stop number 1. Warranty obligations. The everyday application.
Okay, so a warranty obligation pops up anytime a company promises to repair or replace a product after it's sold. But here's the mental shift we really need to make. It's the sale itself that creates the obligation, not the actual product breaking in the future. Because of that cause and effect relationship, the liability has to be accrued at the exact time of the sale, well before anything actually breaks. You might be wondering, how do we actually estimate that liability the second a sale goes through? Well, accounting teams don't just guess. They build the warranty estimate using specific data. They look at historical defect rates, which is basically the percentage of units that usually break. They look at the historical repair cost per claim. They factor in the length of the warranty, because naturally a longer warranty means a bigger accrual. They also assess the specific product type and quality. And finally, they absolutely have to factor in any known product issues or defects that were identified before the financials went out. Let's put some numbers to this so it really clicks. Imagine we have $5 million in current year sales. And based on all that historical data we just talked about, we know we typically have a 2% claim rate. That means the moment we make those sales, we are recognizing a $100,000 warranty liability. Boom. We debit warranty expense for $100,000 and credit warranty liability for $100,000. The expense and the liability happen exactly when that $5 million sale is made. But the process doesn't just stop there. This liability is a living thing. It evolves. We might start with an opening liability of, say, $40,000, add our current year expense of $100,000, subtract the actual claims we paid out, let's call it $30,000, and we're left with a closing liability of $110,000. The key takeaway here: this required disclosure has to be reassessed every single reporting period. If your actual claims start looking way different from your estimates, you'll have to update the liability prospectively. Any significant changes in those warranty rates absolutely must be disclosed. All right, moving on to stop 2, guarantees and indemnifications, the hidden trap. A guarantee basically means you're on the hook to perform if somebody else drops the ball. And honestly, these are massive hidden traps during the period close process. They slip under the radar all the time. We're talking about things like a parent guaranteeing a subsidiary's debt, a seller indemnifying a buyer, or guaranteeing affiliate lease payments. For all of these, the accrual trigger is when payment becomes probable. But here is the massive catch. In all 3 cases, whether you actually accrue a dollar amount or not, disclosure is always required. I really need to sound the alarm on this one. Every single guarantee must be evaluated and disclosed. Even if the chance of you having to pay out is totally remote, you still have to disclose the maximum potential payment. Ignoring remote guarantees is literally one of the most frequently overlooked requirements in financial reporting. So remember, not every guarantee means an immediate loss accrual, but every single one needs to be evaluated and disclosed. No exceptions. Stop number 3, environmental liabilities, the high-stakes estimate. These liabilities hit when a company is on the hook for things like contamination cleanup, restoration, or compliance costs. And because these issues can drag on for incredibly long periods of time, this is a very high-stakes area. It requires tight coordination between accounting, legal counsel, and specialized environmental experts. It also brings up the absolute dread of every accounting team: unasserted claims. When you're dealing with environmental contamination, unasserted claims are a huge danger zone. It leads to this one pivotal question every team wrestles with: should you wait for an official regulatory notice before you accrue? The answer is a loud, definitive no. Do not wait. You have to accrue right now if the contamination happened before year-end and regulatory action is probable. Even before formal action is taken, if you have a probable obligation and you can reasonably estimate the cost, the liability exists today. Teams absolutely cannot sit around waiting for a formal notice of violation in the mail to get this process started. So what exactly goes into this potentially massive estimate? Let's treat it like a checklist. You definitely include investigation and assessment costs, cleanup and remediation, legal and consulting fees that are directly tied to the remediation itself, site restoration, and ongoing monitoring costs. But, and this is crucial, you completely exclude general legal fees that aren't related to the remediation. Those general fees are simply treated as a standard period expense.
And finally, our fourth stop today, premiums, coupons, and rebates, the marketing crossover. I always find this fascinating. A colorful, fun marketing coupon campaign actually follows the exact same rigid ASC 450 logic as a toxic waste cleanup. And let's be honest, sometimes tracking down the actual data from the marketing team can feel just as hazardous. But sales incentive programs, things like loyalty points, coupons, rebates, and free goods, matter to us because they create contingent liabilities. Customers are fully expected to redeem those benefits down the road. So just like a broken product under warranty, a liability has to be recognized when customer redemption becomes both probable and estimable.
$480,000. This isn't just marketing fluff or some hypothetical metric. This is a real, tangible estimated liability that is going to hit the balance sheet hard, reflecting the true financial impact of a campaign.
So how do we arrive at a massive liability like that? Let's walk through the simple math. Let's say the company sold 200,000 units this year. Each unit comes with a coupon for a free accessory, and that accessory costs the company $4. Now, based on historical data, we know the redemption rate usually sits at about 60%. So you take the 200,000 units, multiply by the $4 cost, and then multiply by that 60% historical redemption rate. That gets us exactly to our $480,000 estimated liability. We recognize that premium expense and the corresponding liability right out of the gate.
We've covered a ton of ground today. We've seen how the exact same ASC 450 logic ties together incredibly diverse situations, from a broken widget to a remote guarantee, an environmental spill to a grocery store coupon. But before we wrap up this explainer, I want to leave you with something to chew on. How do all these diverse liabilities behave during a corporate acquisition or a subsequent event? What happens to these careful estimates when a company is suddenly bought or sold? Well, that is the exact puzzle we're going to untangle in Section 5, where we dive into the special recognition rules for business combinations and subsequent events. I'll see you there.